Hello guys, today I'm going to share a secret that no one talks about when it comes to trading gold. I'm going to share a 15-minute easy strategy that you're going to be making money on a daily basis with. So watch this video to the end and you'll be glad you did. This is SAUUSD, and normally I like to do a top-down analysis before I start any trading, and I like to start from daily, then I scale down to 4 hours, then I take my trades on 15 minutes. Now I'm going to show you a secret on how to catch a trade from an impulsive move. Now, one secret about trading is you having to enter a trade from the beginning of an impulsive move rather than entering from the middle. Once a trade is ongoing, you don't need to jump into the trade. You wait for that impulsive move to end before you can take your trade. So what I like to do is that I target the beginning of every impulsive move, and if in any way I missed an impulsive move, what I will do is that I will wait for the end of that move, then I will target the next move after the retracement. So this is daily, so you can see clearly that this is an uptrend. When you go to your monthly, you will see that this is a clearly uptrend trend. Gold has been trending uptrend, and you can see that it was ranging for a very long time, for since 2020. Gold has been ranging. Finally it broke out of that range. As you can see, it broke out of this range, and ever since then it has been going upward, so which makes it easy to trade gold. Gold is the easiest pair to trade, in my own opinion, for now. So far it has traded for 7,161 pips so far. All right, so when we go back to daily, it is still trending uptrend. But what I would like to do is to show you a recap of what happened from 26th January to date, so that you can have an idea of what to expect. So you can see market close bullish this very candle, and it retraced 100% back before it continued buying. So when we scale down to 4 hours, what am I looking at? How do I enter trades? What do I want to see for me to be able to enter a trade? Now, previously I did a video when market was still at this zone. It was stay here, it was buying. So what I like to do is that I put a line on the lowest, or the low, or the previous low, and another line on the previous high. I am looking at this low and this high. So I'm looking at, is the market going to break this low, or is it going to break this high, before I decide on what to do for the week. I'm talking about the whole week. So you plan your trading week from Saturday. You plan it from Saturday, so that from Monday you're able to take trades till Friday. I'm just using the previous week to give you example, so that you can know how you can start doing your own analysis and get a good win rate. So you mark the low and the high, and you wait for this market to either get here or get here before you can take a trade. So as you can see, when the market, in my previous video, I saw this move. It has already broken this level. Of course, as soon as it broke this level, I knew that the next thing I'm supposed to wait for is a retracement. So the market was retracing. As it was retracing back, so I was waiting for it to get to this zone, this low, to know if it's going to break this low. If it breaks this low, it tells me that, oh, we are bearish. But it breaks this high, it tells me that we are still bullish. So what I was waiting for it to break this low, as soon as it do not break this low, I know that, oh, we are still. So as it got here, I saw this rejection. So what I did was I waited for it to come back there again, which it did. As soon as it came back here again and printed this bullish candle, I jumped into the trade from here. I targeted this high. This was where I targeted. So my take profit was here, and as I entered from this second candle, my stop loss was below this very candle, so that if peradventure it was still going to come back there, I know that it will not take me out. But normally what I do, to be honest with you, I do not use stop loss, because the reason why I don't use stop loss is because the market can spike, take your stop loss and continue going your direction. So I do not use stop loss. So what I normally do is that I put a line and I wait if this and I'll be watching the market. If the next candle breaks down and close with the body below, then that is my exit. I know that the setup has failed, so I exit. You plan for your exit and your take profit. So I plan for my exit. Of course, like I said, I do not use stop loss because of several spike that will stop you out and continue your direction. So the best is for you not to use stop loss, but that does not mean that you should just leave your trade like that. You will be monitoring your trade, and your exit strategy is that I do not use stop loss, because severally the market will spike, take you out and continue your direction, and you don't want that. So but that does not mean that you just leave your trades just like that. You will have an exit plan at hand, so that if it didn't go your way, you know exactly where to exit. So what I normally do is that I will plan for that exit. Take for instance, assuming as I took this trade from here, and you can see it started retracing back. So I'm watching my trade to see if this market will come and break this line, this very place, or even this very other place with the body and close with the body. Then I will exit the market. I will exit the market immediately, or I wait for a retracement back up before I exit. But if not, at times market can spike down like this and it will now melt back, leaving here with a wick. Yes. So at times it will spike all the way down. It will spike all the way down and then it will melt back, leaving here with a wick. So, and you're still in the trade. And though, of course, by the time it will spike back like this, you will be on a massive drawdown. But that is notwithstanding. After that, you will gain your money back and it will continue your direction. As a spike back like this, the next thing is that this candle will turn to a bullish candle automatically. So you see the reason why I do not use stop loss, but you have to be systematic with it so that you do not blow your account. Before you can embark on this kind of strategy, you must test it first of all with a small loss, the least 0.01 loss size. And of course, you can't try this on anything less than $100. Your account must be at least $100 before you can try this, and with one position. Don't forget, this is gold, and gold, a pip in gold is 10, whereas in Euro USD a pip is just 1. So you can imagine the gap, the difference. So in doing this, make sure you have at least $100 funded and use 0.01 with one position. Then you can only add positions when you see that the market has already this high that it created. See this high that the market created. So when this high that the market created, when it breaks it, that's when you will add another position. So you see, as soon as the market breaks this high and close with the body just like so, then you can add many other positions. If you want to stack, this is where to do your stacking. So you do your stacking from this candle to this candle, and of course, as soon as it breaks, of course, this is your take profit. As soon as it breaks this high, you exit. So that is the right way to trade. Do not be greedy. Do not be greedy. So you wait for the market to create another high and another low for you to be able to take trade. So let's continue. Remember, don't forget, this video centers on 15 minutes, easy 15 minutes strategy.